We're in New Zealand now. This is the final stop on a Rich Dad tour. I've been on a tour with Robert Kiyosaki, doing these Rich Dad events in Kuala Lumpur, Singapore, Australia, and New Zealand.
And what an incredible ride, and what an incredible view. New Zealand is absolutely incredible. Auckland is beautiful.
This opportunity isn't going to last for long. There are these brief moments throughout history that go by, you know, as far as historic time, they go by in the blink of an eye, where the safest place to be, the place where people run to protect their financial well-being during economic crisis, gold and silver. They have been the safe haven for your finances for 5,000 years. And there's these brief moments in history where they simultaneously become the asset class that has the single greatest potential gains in absolute purchasing power, and we're in one of those right now. With every time they create new currency, and they're doing massive currency creation now, it creates a bubble somewhere. I believe the next great bubble is destined to be commodities and the precious metals. And what's amazing is I left with a bunch of these sort of ugly pieces of paper with pictures of dead guys on them that are from the US, and then you arrive in Kuala Lumpur and in Malaysia, and you trade them for some prettier pictures, pieces of paper with pictures of people on them. I don't know if they're living or dead or what, but then you leave there and go to Singapore, and you trade them for pretty pieces of paper that have now they've got like little windows you can look through in them, a little clear spot, watermarks, all this kind of stuff. And then you get to Australia and you trade them for even, they've got more vibrant colors on their currency, which I sort of like. I think the American currency is pretty drab and way outdated. We're just catching up to the rest of the world when it comes to the security that's in the notes to make them less counterfeitable. And then come to New Zealand and trade them again for different pieces of paper. And what cracks me up is governments are sitting there cranking out this stuff on a printing press, just laughing all the way to the bank, and we actually work for this stuff. I mean, we really work our asses off our whole lives for this stuff that they're just cranking out, at a tremendous rate here. And it transfers, our true wealth is measured in our time. And it's our labor and the time that we have in our lives to create things. And they're able to get some of that time and labor at no expense by just cranking out this stuff. It's amazing. This will sound a little bit weird to some of the viewers, but I try to differentiate between currency and money. Currency has to be a medium of exchange. We've got to be able to buy and sell things with it. A unit of account. It's got to be portable, divisible, which means you can make change, durable, and then something called fungible. Fungible means that each unit is interchangeable. The dollar in my pocket buys the same amount as a dollar in your pocket, no difference to them. Money has to have all of those attributes, plus it has to be a store of value over long periods of time.
If this is sunk on a boat and a ship now, or it was 500 years ago, you dig it up, it has tremendous value. There will be numismatic value plus the real value of gold. This sinks, you put it to the bottom, and who cares? This loses probably 5 to 10% a year in value.
It's amazing. It was a long road and series of very small transitions to get here. But basically, we used to use gold and silver, and then they come out with representations for gold and silver. All the currency in the United States and in most countries was redeemable for gold or silver at one time. In the United States, our currency used to say there have been deposited with the Treasury of the United States $100 in gold coin payable to the bearer upon demand. You go into any bank, slap down your currency on the counter, and ask for your money, your gold and silver, and they would give it to you. Then, we were on something called the classical gold standard that started in about 1873 in Germany, and by 1900, almost every country on the planet was on this gold standard, where you had a certain amount of gold in the treasury and you created a certain amount of notes that equaled the amount of gold in the treasury. So it was a one-to-one ratio. It was fully backed. Fiat means an order by an authority that has the power to enforce that order, or a decree. And so the governments can enforce the value of their currency, or make sure that their currency is the currency that's used, by making taxes only payable in that currency. So fiat currencies are given value by government decree. There's no intrinsic value to them. In fact, it costs about 6 cents to create a dollar bill or a $100 bill, but basically there's maybe 3 cents worth of paper and ink, and then some labor and transport and all that stuff, except they've ruined the piece of paper. You can't write a list on it now because they printed it with ink. So basically, one thing you find out is all fiat currencies eventually fall to their intrinsic value, which, because they've ruined it by putting ink on it, is the amount of energy you can extract from it, the amount of BTUs from combustion when you burn it. And you saw that during the Weimar hyperinflation. People used the currency as fuel to heat their house.
Currencies have been backed by oil, by gold and silver, by land. As soon as you remove something that puts financial constraint on them, where you can't just print as much of it as you want, the currency is pretty much doomed.
It's beyond astonishing. And if it wasn't for the horrific effects, it would be more ludicrous. It would be actually comical that we could stand up and have some fun with it. But it is actually horrific. When you look back in history for the last 3,000 years, every episode of this kind of silly crap ended very, very badly.
You can see them repeating the same stupid mistakes today. And those mistakes, you go through history and you see something that's happened 100 times in the past, and then you see them doing the same thing to our currency supply today. The same, in the U.S., the deficit spending is out of control. And the currency creation, we'll put up a chart of base money in the United States. Mm-hmm. So it's a chart of the cash in circulation, currency in circulation, plus the deposits that the commercial banks have at the Federal Reserve. And it took 200 years to go from $0 in existence, paper dollars, to 825 billion paper dollars that exist. And then it took just a few months to go from that to about 1.75 trillion. And that was with the Bear Stearns, Fannie Mae, Freddie Mac bailouts. And then we had, in March of 2008, March of 2009, they announced another 1.2 trillion dollars worth of, and part of that is actually purchasing bonds directly from the Treasury. Now, when they do that, that's just printing currency. That's like just running the printing press. But so the total comes to about 3 trillion paper dollars that will exist very shortly here. That's an from 825 billion to 3 trillion is an expansion of almost 4 times. I mean, it's just ridiculous.
So there will be more this printed than ever before, which means the dollar keeps coming down and other things keep going up. And that's really what's going to happen. It's predictable. And eventually this will go to its true worth, 0. So all of you savers out there and people trying to save this trash, you're going to lose big time.
They just type them into a computer, the dollars. They don't have to print them anymore. It used to be that you had to mint coinage to expand the currency supply. Then you had to print paper to expand the currency supply. But now all you do is you add zeros to it. And boom, it's 10 times.
They don't even have to print this trash anymore.
Right.
It's electronic. That is how fast it's going to hit people.
If I can, as a member of Congress, I can find out more information about what the CIA is doing than what the FOMC is doing, the central bank, what they're doing on monetary policy. That's very, very secretive. The Federal Reserve has been given the power and the authority to create money out of thin air.
The way it works, the Federal Reserve, which is neither federal nor has reserves, it's a private corporation, and you can see this by going to their website and you go to the frequently asked questions. The first question is the Federal Reserve private? And they make their answer very obscure. If you read between the lines, it basically says, well, no, but maybe yes, but sort of no, but really yes, but definitely not. That's what it says. Then, second question, does the Federal Reserve have stockholders? Answer, yes, and by law they are paid a 6% dividend. And it couldn't be more clear. So in the answer to the second question lies the answer to the first. There is no federal agency that has stockholders. If it's got stockholders, it's private. It's that simple. But the way they create currency, the Treasury creates a pretty piece of paper with some ink on it called a bond, and that's basically an IOU. They're going to borrow something from somebody, and it says, I owe you whatever I'm borrowing plus interest over 30 years at such and such percentage. The Federal Reserve then opens up their big old checkbook that has a zero balance in it. They're broke. There's nothing there. It's 0.00 is the balance. And they write a check for that $100, or in the case of today, trillions, but they write that check and hand that to the Treasury, and when they give that to the Treasury, that currency springs into existence. The Treasury then deposits that into the various branches of the government, and the government throws a few wars, does some deficit spending, what we call pork barrel spending in the United States on things like a bridge to nowhere and stuff like that. And then it eventually ends up in government employees' hands, in the contractors' hands, and so on, and gets deposited into private banks. And then comes the miracle of fractional reserve banking. Say for every $10 that you deposit in your checking account, each country will have its own reserve ratios, but in the United States for years we had a 10% reserve ratio on checking accounts. They deposit it into a checking account. The bank is allowed to loan out. If you deposit 10, they're allowed to loan out 9. And that gets loaned usually to somebody that's buying something. They're buying a house. They're going to sign a mortgage. That's how they're borrowing the money. They're signing this mortgage. They take that $9, they buy the house, and that's going to get deposited into the checking account of the seller of the house. And then, since that's in a checking account under a 10% reserve ratio, they get to loan out 90% of that, which gets redeposited, 90% of that, which gets redeposited, and so on. And for every $10, it creates $100 of brand new currency through fractional reserve banking, and that's actually where most of the currency supply comes from.
The fractional reserve thing, if in the old days anybody wanted to borrow any money, you had to go to the bank and borrow it from the people who were saving money.
Yeah.
Nobody does that anymore. People aren't saving much to start with, and the money you borrow from a bank does not come from the savers. It comes from the bank, as you say, creating it on the spot when you sign your name to the loan document. It's created on the spot. One of the things I've been ragging about is the reserves in the banks. Reserves in the banks have not increased a dime in 10 years. It's the same $41 billion. There's $41 billion of reserves in the banks against how many trillions?
Just 7% of our money supply has a 10% reserve. So that means 0.7% of cash in existence to cover the other, what is that, 99.3%.
It's insane.
Of the money supply.
That's right, that's right. So you talk about fractional reserve. There's no fractional reserve. What's
Right.
the fraction?
There's nothing there.
There's nothing there. 1 cent on $1 million is not much of a fractional reserve.
Right.
Golly.
So getting back to this expansion of how the money supply is created, most of the currency, about 10% or so is base money, and then, which is that hocus pocus voodoo scam where the Treasury creates an IOU and the Federal Reserve or the central bank of whichever country. So depending on the country, it'll be the Ministry of Finance and then their central bank, which may be labeled Reserve Bank or something like that. And really, when that central bank writes a check is really an IOU too, right? It's an IOU cash, and you can take it to the bank and redeem that check for cash. So they swap IOUs, and currency springs into existence. The thing is, though, after that currency springs into existence and then it gets magnified by fractional reserve banking, we work our asses off for this stuff and save up some of it so that we pay tax to the Treasury so that they can pay back the Federal Reserve or the central bank of whichever country it is, the principal plus interest to a private corporation that has, it's not federal and it has no reserves.
And has stockholders.
Yeah, it has stockholders. It's like the biggest scam that has ever been perpetrated. It's amazing in the United States that we've gone along with this for close to 100 years.
The facts are there. Every fact that there is supports the argument. There is a conspiracy to steal all the money from all of us and give it to the banks.
The Federal Reserve makes credit available, but in a way it's fraudulent and it's theft because it does have value. You know, if you go to the bank and they give you $1 million, we all take it. But it becomes valuable only by diluting the value of somebody else who's holding money. If there are those who are left saving money, they're being robbed.
The majority is highly leveraged out on debt. And
Are they?
If they win by us going right into a hyperinflation, the mass stupidity is winning at the expense of the banking system. I've never seen the big boys lose. In all of monetary history, it's
That's
the big
right.
boys that win. So a short-term deflation would transfer all everybody's property to the banks.
To the banks.
And then you go into a big inflation, and again, the little guys lose, and the banks win.
Well, you know, there are people who think that that is actually the conspiracy that's operating, making the whole system go, that is the point of the whole thing. And it's hard to argue against it.
I have never seen a projected deficit come out on target. They always go past whatever their projections are. So if they're projecting a $1.75 trillion deficit, it's going to be 2 or 2.25, something like that, when all is said and done. And then after this 2009, I mean, the deficit projections, if you look at a deficit chart with a zero line, you know, balanced budget, this deficit is just like dropping off the bottom of the chart. And then it's supposed to get smaller. In 2010, 11, 12, we're supposed to have smaller and smaller deficits. But there is this enormous wave of mortgage resets.
We are in uncharted waters. We are in, I think, as Jim Pavlova said, the perfect storm. I think, and what's interesting about it, from my perspective, is that we're just starting to see, you know, the sea starting to get rough.
The oscillations.
We're nowhere near what I believe is coming a few years out, which is like the huge tsunami that's going to really, really rock the markets.
These are some huge waves in 2010 and 2011 of mortgage resets for the adjustable rate, the ARMs, the option ARMs and so on. Yeah, this second wave. And it's as much as caused the financial crisis in the first place. This time, though, they're probably not going to allow these people to go into foreclosure. What they're going to do is bail them out, which means the deficit spending is just going to get worse in 2010 and 11.
They can't do a thing about this. It's too late. It doesn't matter. What matters is how smart you are now. If you think these guys are going to save your family, I think you're in for a sad, rude awakening.
I mean, it's one thing to say the federal budget is in deficit, but every year there's supplemental appropriations go far beyond that. So basically we're running $600 billion a year in debt every year just to fund the excesses.
They claim that the budget deficit is 200 and something or 318 billion.
According to the budget.
All you have to do, though, to see what the real deficit is is what did we owe last year and how much do we
owe this year? That's right. And it's about 600 billion.
I think it's 750 billion.
Oh, is that much now? Oh, man. I'm going to laugh again.
Makes your head spin.
It's beyond, just makes your head explode that this can't be right. Why are we the only guys that seem to understand this?
And they're borrowing money. They're going into the end game now because the money they're borrowing is starting to go exponential. It's doubling at a quicker and quicker and quicker rate. And there comes an end game where you're borrowing so much money each year to pay the interest on the borrowed money.
That's right.
That you have to go into hyperinflation.
Yes, the exponential curve thing is one of the things that's always bothered me. That's a problem with exponential curves. They sooner or later go straight up to infinity. They start off nice and easy.
Yeah.
Oh, no problem. We're basically, I only owe a penny more this year. After a while, as time goes on, that curve gets steeper and steeper. You've got to borrow more and more and more money until suddenly you're into hyperinflation because there's no way out. If you don't hyperinflate the money supply, the thing falls apart.
Right.
What are you going to do?
Well, throughout history, whenever societies create a whole bunch of units of currency, they start off with a certain amount of money in their society, gold and silver, and they come out with representations of gold and silver, like paper notes or debased coinage, where you're mixing it with copper, and they increase the currency supply. And gold and silver sort of lays dormant. It lays in wait until the public realizes, they start to sense the inflation of prices that are caused by the inflation of the currency supply. True inflation is the inflation of the currency supply. Rising prices are the symptom of the monetary inflation. And then they rush back toward gold and silver to protect their purchasing power, and in doing so, they bid the price up until it accounts for the currency supply. It's an amazing process, and I show this in my book, Rich Dad's Advisor's Guide to Investing in Gold and Silver. There's a couple of charts in there. With the Federal Reserve, we have hard data, and I've got some data from the Weimar hyperinflation, where gold went from 100 marks an ounce to 87 trillion marks an ounce. But what you see with the Federal Reserve data is that the price of gold, the will of the public and the free markets do this over and over and over again throughout history. They bid the price of gold and silver up. So with the price of gold, the gold at the U.S. Treasury rose in 1934 till its value equaled the value of all the paper dollars in existence that promised to pay gold. In 1980, it did the same thing.
Never in the history of the world has this ever happened. In 1971, the U.S. and Nixon convinced the entire world to replace gold and silver with paper money. This stuff. Cash is trash.
We had to abandon Bretton Woods because the U.S. vaults were basically getting cleaned out.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
Because the Bretton Woods system had put the whole world on a dollar standard, all countries on the planet were backing their currency with dollars. The dollar was then backed by gold at $35 an ounce, meaning that all currencies were pegged to gold through the dollar, and they didn't fluctuate. They weren't floating on the foreign currency exchange. All currencies remained pegged to one another through the dollar to gold. When we unpegged from gold in 1971, when Nixon closed the gold window, all currencies became free-floating, or I call them free-falling against gold. They don't actually float. The dollar used to be worth 1/20th of an ounce of gold. Today it's 1/1000th of an ounce, and it's on its way toward less than 1/10,000th pretty soon. Once he unpegged, gold rose, and it went from 35 to 200 in 74, back down to 100 by late 76, and then up to 850 by 1980. In doing so, in one of the other graphs in my book, I show that it covered the entire currency supply of the base money, it's called, the paper dollars that exist, at about $400 or $500 an ounce, the value of all the gold at the Treasury was equivalent to all the gold, or all the paper dollars that existed. So we could have, there was a year where we could have gone back on the gold standard. Then at about $600 or $650 an ounce, it also covered all outstanding revolving credit or unpaid credit card balances. Most people don't know that when you make a charge and you go to a restaurant and eat, or you go to the grocery store and buy something on your credit card, when you sign that credit card, you're expanding the currency supply of the planet. The bank doesn't loan you anything. They create a book entry, and you have just created the currency that you allowed, you created the currency and you spent it, but you allowed the bank to charge you interest on it as though it was theirs. All they did was make a book entry for you. That's a pretty good scam too. The important thing here is that when you're eating at a restaurant or shopping at a grocery store or buying clothes or whatever, when you pay with a credit card, those dollars that you created go into a checking account exactly the same as if you had paid with paper dollars. And they circulate until somebody saves them up and pays down credit card debt. So in my book, I argue that that you have to include outstanding revolving credit as part of base money for this particular measurement that I'm doing, which is how gold how it revalues itself. The will of the public and the free markets revalue gold to account for the currency supply. And again, in 1980, there was about 3 months where it covered all outstanding revolving credit and base money, both. And there was a year where we could have gone back on the gold standard. Well, at the end of my book, I have the same graph, and I show the expansion of the currency supply that has happened since. Now, this process, or something very close to it, has been going on since the year 407 BC with the first great inflation in Athens. And it happened several times in Rome. There were a couple of hyperinflations during the French Revolution. But it happens over and over and over again on this planet. And it's not like clockwork, but it's highly reliable. When a government abuses its currency system, gold will do this. And at the end of the book, I show it would take $7,300 an ounce for history to repeat and for it to do the same thing that it has done hundreds and hundreds of times throughout history. However, the currency supply, base money, is just exploding. Outstanding revolving credit topped $1 trillion for the first time this year. And so for history to repeat today, and for gold to cover that portion of the currency supply that it covered in 1980, 1934, 1923 in Weimar Germany, and like I said, hundreds of times throughout history, it now requires about a $15,000 per ounce price if the U.S. stops all the ridiculous deficit spending and currency creation that they're doing, if they stop that today. And they're not going to.
Is there ever any example in history of a government being able to print or borrow its way to prosperity?
Only temporarily. And I would say that we're in that stage right now. We're temporarily very wealthy because there's still this trust in the dollar. And I would say 30 years, since it's just pure fiat money, since 71, 30 some years now, that we have, on the short run, benefited by this. But long term, no, I don't think there's any example. The longer it goes and the more pervasive it is, the more likely it is you're going to end up with runaway inflation.
You know, one of the things I say is, all frauds typically end rather suddenly and rather swiftly. And this is why I think in the past we've seen such parabolic curves upwards in the gold price at times, or even just very quick revaluations at times, because, in all currencies, because they're currencies when they start to die and people lose confidence in the fraud, people aren't going to gold and silver in mass hysteria or in a it's a sudden, when it happens, it is a sudden realization of rationality that is hitting the marketplace, and it's harder to stop rational thought than anything else. It's not people going crazy for gold and silver, it's them waking up out of their delusions of paper money. And just like Enron was a fraud and collapsed suddenly, so too will our dollar.
Gold and silver do an accounting periodically throughout history. It's really exciting to see this. They automatically revalue themselves when the public wakes up, and they catch up to all the currency that's been produced. And there's this same tiny little pile of 2 billion ounces of gold that there was back in 1980. And the pile of silver has gone from 2.2 billion ounces to 300 million. Today, there's 8.3 times more gold available for investors to buy than there is silver.
I want you guys to hear I don't think we heard what he just said, okay? To me, I've been saying this for a number of years now. Silver is the biggest opportunity I have ever seen, bigger than real estate, bigger than anything else.
The wealth transfer that is going on right now is enormous. This is the greatest opportunity in the history of mankind because this is going to be the greatest wealth transfer in the history of mankind. Never before have all the world's currencies been fiat currencies at the same time. This is the very first time that that has happened. And gold being a freely traded, separate commodity / money. Right now, gold has begun this accounting again, although this time it's going to be worldwide, and this time there's a blizzard of paper right now. All that paper throughout history tries to come and land on this same tiny little pile of metal periodically, the pile of silver is 1/10 the size roughly that it was in 1980, the last time that silver hit $50. Today it's $15 roughly. Silver is just one of the most undervalued things that there is. There's so little of it today. The past 3-4 years or so have seen the above ground supplies of silver measured, if you're measuring it as a percentage of usage rates, how much we're using. There's a good graph that the CPM group, which is one of the 2 agencies that are used by the industry, the precious metals industry, they're hired to do worldwide audits of supply and demand and where that gold and the precious metals are being used. They have a graph where they show it as how many months of supply are above ground. In other words, if you shut off mining at any given moment, how long would the silver or gold that we have above ground last? And normally, before the 60s, we always had like 10, 20 years or more of supply. Throughout the 80s, 70s and 80s, it sort of bounced around between 2.5 and 5 years. And then in the 90s it started falling, and by 2006 we were down to 3 months. 3 months of above ground supplies compared to like 10 years normally. Silver is extremely rare. For the first time in human history, there is more gold for investors to buy than silver. That has never happened before. In fact, if you took all the gold and put it into a cube, you could fit it on a tennis court. It would be a little bit less than 20 meters on each side. But silver is far more rare. If you put it into a cube, it would measure a little bit less than 12 meters on each side. So I believe silver is the better investment of the two. Silver's price is 1/65 of gold's price. For the first 2,000 years that gold and silver were money, silver's exchange rate to gold, its value, was 1/12 of gold's price on the average. It bounced up and down, but there's a pretty good reason for that. I don't have hard proof on this. I can't tell you exactly what quantities of gold versus silver were in circulation, but 1/12 is a real interesting exchange rate because it's also roughly the amount of mineable supplies of gold and silver in the Earth's crust. There's about 12 times more mineable silver than there is gold. So when you dig it up, the average quantities circulating were probably 12 times more silver circulating than gold, and it was simply the free markets and something called the price discovery mechanism, discovering how much gold and silver were in circulation. I use farmers in Florida as an example because that's where a lot of the oranges are grown in the United States. So a farmer in Florida, they grow too many oranges one year, and the supply goes way up and demand is still down here. Price has to fall until orange juice goes below apple juice and enough people switch over to drinking orange juice so that supply rises to meet demand. The next year they have a freeze and supply goes way down here, and then prices have to go up high enough to bid those scarce oranges out of the farmer's hands to make demand fall to meet the supply. And it's a marvelously efficient mechanism that is completely brainless, mindless. It's the total sum of all the transactions that go on in a society. Two people trying to strike a price on something. And so I believe that the reason for the exchange rate for the first 2,000 years was simply the price discovery mechanism, finding out what quantities of gold and silver were available. Well, right now, silver's value is 1/65th of gold's value, yet there's about 8 times more gold for investors to buy than there is silver. This doesn't add up. The free markets will adjust this. Like I said in my book, right now, if they stop creating currency today, that means that gold should go to $15,000 an ounce. But silver, I believe it should go down to at least the 10-1 ratio. You know, it should overshoot. Whenever anything gets way out of whack to one side, when it overshoots the mean, when it reverts to the mean, it overshoots. And the further out of whack it is, the further it overshoots. If silver goes to the logical 10-to-1 ratio, that's $1,500 silver. That means you would have a gain of 100 times on silver versus only 15 times on gold. And if silver should remain more rare than gold even in the peak. So there is a possibility that you could see silver, I mean, it's within the realm of possibility. I'm not saying it's going there, but silver's price could be higher than gold's price, and that could be by multiples. It's possible that you could see silver at 5 or 8 times gold's price.
The theory here is that because of the scarcity of silver and scarcity giving real things value, this could be worth as much as or more than gold during a super mega spike that could and should happen to induce more silver mining.
This opportunity isn't going to last for long. It's going to be there are these brief moments throughout history that go by, you know, as far as historic time, they go by in the blink of an eye, where the safest place to be, the place where people run to protect their financial well-being during economic crisis, gold and silver. They have been the safe haven for your finances for 5,000 years. And there's these brief moments in history where they simultaneously become the asset class that has the single greatest potential gains in absolute purchasing power, and we're in one of those right now. And I don't know why anybody would want to have any investment that wasn't the safest thing that it possibly is, the only thing that has never gone to zero for 5,000 years, and it currently has the greatest potential of making gains in absolute purchasing power, and it's all due to the recklessness of world governments having to, you know, the U.S. is doing this massive deficit spending and printing. When we print and dilute our purchasing power, dilute the value of the dollar, what happens to the exchange rate, like here in New Zealand? The Kiwi dollar goes up, the U.S. dollar falls, and then exports from New Zealand to the United States fall. So to get those exports going again, you have to print also. And every government on earth is doing that right now. They haven't caught up with the massive printing that we just started with the Fannie Mae and Freddie Mac bailouts and stuff. But if you look at currency creation, I was showing a chart in Sydney to the audience. There were 6.7 billion Aussie dollars in existence in 1960. There are 1.2 trillion Aussie dollars in existence today. That's 180 times more Aussie dollars in existence. And it's like that with the M2 currency supply of China it's been exploding at rates that are double-digit every year. There's this blizzard of paper. All countries on Earth are going into these, if you chart it, the printing of currency is exponential. And that means that gold and silver are eventually going to catch up with all of this paper as they revalue themselves. But they lie in wait for a little while, and then the move sort of happens suddenly. And that's your opportunity. That's this enormous wealth transfer. I think Ron Paul has had a huge effect, especially on the awareness of the Federal Reserve. And as a byproduct, he's created an awful lot of gold and silver fans because you know, people in the United States are discovering that you know, it's in our Constitution that only gold and silver can be money in the United States, and that the Federal Reserve notes are illegal, unconstitutional money that we're not supposed to be using. The reason why is the currency that founded the United States, the Continental dollar, the first dollar of the United States, went to zero in hyperinflation because the Revolutionary War was basically funded solely on deficit spending. They were just printing the currency and spending it. It started out at trading at a 1-1 ratio with the Spanish mill dollar. This is before the U.S. silver dollar existed. The Spanish mill dollar had the same weight of silver in it as a U.S. silver dollar. And it fell to where by 1779 it was it took 1,000 continentals to buy a Spanish mill dollar. By 1783 they were toilet paper. So having just been through a hyperinflation, the founders of the United States of America put in they saw the damage it does, how it wipes out what we would consider the middle class, but it wipes out any holders of paper currency lose all their purchasing power to the holders of real money. And so Ron Paul has brought about a big recognition of that. I really like Ron Paul, and it's a shame that I wanted him to be president, but at the same time I didn't want him to, because he would get blamed for all the stuff that's happening that's really the fault of all of the previous presidents, but basically George Bush Jr. and Alan Greenspan. They're the ones that are really to blame for the mess that we're in. And the American public themselves for being allowing themselves to be taken for this ride and just going along with it.
What do you think the founders of this country would say? I mean, if Thomas Jefferson or Andrew Jackson came back today and took a look at what has happened to their country, to this system that they laid out in the Constitution, what would their view of what our society is? What would it be? Do you think they would describe us as socialists, as communists?
Yeah, but they might want to arrest us and put us in prison, especially Congress. Because, you know, what was interesting on the monetary issue, the Monetary Act of 1792, the first one after the Constitution, said that if you participated in counterfeiting, that you could get the death penalty. And to them, counterfeiting was printing notes that were worthless.
Bills of credit. Because
they knew what it was like when the
Federal Reserve notes.
when the Continental dollar went to zero, and they knew what runaway inflation was. And I'm sure Jefferson and others would say, look, don't you remember, you know, what happened? So if they instituted the death penalty for counterfeiting, he would say, you know, in a moral sense, this is what we've done. We have legalized counterfeiting. You and I can't counterfeit. Fortunately, that's still against the law because it's fraud. But why is it that the government's allowed to do what we're not allowed to do?
Yes, it was. It was like 816, I think, would buy a single-family medium-price home.
So what you're saying,
except there was a lot more silver, and we weren't in as I don't think that bubble is going to be anything compared to this next bubble. So, in my book, I said it wouldn't surprise me to see less than 500 ounces of silver by a single-family medium-price home, which is pretty amazing because you're talking about setting aside somewhere between $8,000 and $9,000 today to be able to buy trade that straight over for a single-family medium-price home in the United States, which peaked at about $228,000, and now it's falling probably about $200,000 or $195,000 today. I haven't checked, but it's Realtors Association data. You can go to their website and get the data. But you know, if gold goes where I think it's going, and silver goes to the 10-1 valuation, which is entirely possible, it could be that just a couple hundred ounces, like 200 ounces of silver, buys a single-family medium-price home. So you know, each 100 ounces is only $1,500–1,600. So you're talking about. Sometimes when I say these things, I can't believe I'm saying them, but they're just entirely logical things, and it's just and it's stuff like this has happened before. But it would be like you'd set aside $3,000, $4,000 today in silver, and trade it for a home someday in the future. And I don't think it's going to be that long. It's going to be probably between 2 and 5 years, maybe a little bit longer, 6 years, 2015 at the latest, I think. It just, you know, that's what it feels like. If they are not financially literate, if they're not financially educated, they should be. You know, I'm with the Rich Dad team, and Robert is a big real estate investor, but he gets cash flow real estate, and he gets it in the right sectors. I mean, you know, he moved out of Class A properties several years ago and started moving into B and C rental properties. This is working class properties. These are apartments that rent for less than $500 a month US. You know, that's where he's at. Well, with the whole popping of the real estate bubble, everybody that gets foreclosed on has to live somewhere. So right now there's this huge shortage of his type of real estate and high demand. So if you know what you're doing, real estate is still an excellent investment. But for the uneducated investor, yes, get out of your real estate and get into precious metals as soon as possible. I am not a gold bug or a silver bug. I'm a cycles guy. This is the cycle right now for commodities and precious metals, and all you have to do to prove that to yourself is take a single-family medium-price home and divide it by the price of gold, a barrel of oil, a bushel of wheat, a ton of iron, a pound of copper. And what you'll find is that real estate and stock markets have been falling since somewhere between 99 and 2001, depending on what you choose to measure it with. But they have been going down against anything tangible. They have, and people think that they've been going up, but people always chase yesterday's news. And that's what they're doing right now. They're chasing yesterday's news. You know, I've been just very, very consistent since 2002. I've been preaching and buying precious metals, and there's going to come a time when it's over with, and when I won't be able to honestly go out and look somebody in the eye and tell them that precious metals is a good investment. And instead, I've set up my business so that I'll be able to tell them that no, precious metals isn't a good investment. Get out, it's time to buy real estate, it's time to buy stocks. So the main thing, get a financial education, get financially literate, and right now we're in the portion of the cycle that's the easiest. Gold and silver are just really, I mean, they're good investments, but at the same time they're dumb investments. They don't take a lot of financial literacy to, I mean, you buy them and you sit on them until they're overvalued, and then you sell them and buy something else. So they don't take a lot of work. It takes more of a financial education to be a landlord or to be in the stock markets or the currency exchanges or something like that. This takes a lot of talent, knowledge, and maintenance, where with gold and silver, you know, you buy it. The hard part is selling it when the top, where is the top, you know. I can measure those things, and I have a team of researchers that's their job, is every day, is just to try and figure out how to measure this stuff so that we can pick the top and get out of it. Because like I said, in my company, we're a group of cycles investors. We're not precious metals bugs.
And if there's one piece of advice that I would give to your viewers, it's that we're still early on in the cycle of moving out of financial assets, moving into tangible assets of all sorts. And the easiest way to acquire tangible assets is to accumulate gold and silver.
So when money does start flooding into gold, when gold gets to 1,500 or 2,000, a lot of people are going to start looking over at silver that'll only be $50 an ounce by then and start buying silver.
When everyone realizes what's happening, it's going to be a gold rush into this thing that will be it'll just blow people away.
It'll be the biggest one in history.
Yeah, it's going to make even in the shares, it's going to make the NASDAQ boom look like nothing. And the difference will be this will be for real, and that was, that really was a bubble. Now, it doesn't mean that we won't have a bubble in the gold market and silver markets, but the move itself will be intrinsically real, and
I believe that this is the next big bubble, is the precious metals, commodities, but precious metals especially, because of the helicopter drops they're doing right now. Of all the money they're creating, that has to find a home. Well, the stocks had their bubble in 2000. Real estate had its bubble in 2006. And, what's the next asset class to go into a bubble?
Well, then the real difference is that gold and silver are tiny little markets. And as you say, is investing money in the hoards, the institutions and pension funds, and even the general public, when they actually realize what's going on and they all try to get in this little market, that's when you get the ballistic kind of move.
Yeah, extraordinary fireworks.
I think so.
Yeah.